Welcome to Money and Freedom, the podcast where you learn to become financially free using value investing. We're going to talk about a quantitative way of being a value investor. And why would we do that? Why will I show you this way? This is a way where you can be a value investor in an automatic way. Why would you do that? Well, what I've realized is that value investing, the way I do it, is really great, but it does take some time. And some people, life happens. Maybe you have a baby, maybe you're building a house, maybe something else happens and you just don't have that much time. And if you're doing value investing the way I prefer to do it, and life happens as it does, for a lot of people that means they completely stop investing, and that's not great either. So I'm going to show you a different way where you can keep investing even though some things take up a lot of time in your life. Even though, as I call it, life happens. So the inspiration for this kind of investing is this book called The Little Book That Beats the Market by Joel Greenblatt. And he shows a very particular way of investing that you can do in a way that's automatic. You could almost compare it with index investing in the sense that you don't even have to analyze anything or make a lot of decisions. You just have to follow the system. So what is it that you have to follow? And now I'm going to give you a lot of terms, maybe terms that you don't already know. Don't worry about it, because just listen, relax, don't stop the car if you're driving. And later, you can download a cheat sheet, which you will find either in the show notes or in the comments below, wherever you're watching from. Okay, so how do you do this? Joe Greenblatt says to go for a high return on invested capital and a high earnings yield. What does that mean? Instead of the earnings yield, by the way, you can also take a low PE. Let's just look a little bit at what it actually means. So he says that a high earnings yield means that the stock the company is trading at a good price. And the same with a PE. A PE, what does a PE mean? It means price earnings. So it is a number where you take the price and you compare it with the earnings. It's actually super, super simple. It really means that if the PE is 20, and this is super easy to look up, by the way, you can just Google the company, you can Google Apple stock, and the first page that comes, you can see the PE right there. So if the PE is 20, that means that you're willing to pay, or whoever buys the stock at that price is willing to pay $20 for $1 of earnings. That's all it means. So the lower the PE is, the better the price is. So if the PE is 10, you're paying $10 for $1 of earnings. And a high return on invested capital is a sign that it's a good company in the sense that they're good at making money. So, but if you didn't catch that right now, don't worry, get the cheat sheet later. I'll make you a cheat sheet where you can see all of it in one page, this and whatever else I'm going to say. Don't worry about it. Just listen, relax. He says, Joe Greenblatt, and I'm stressing that he says this because you can do this in a lot of different ways. So this is his method, and you can adapt this to you. Anyway, he says that you should invest in 30 companies and rotate. And these companies must have a minimum market cap of $50 million. We'll get back to that in a second. What are the advantages of this way of investing? The advantages is that you don't have to take the company through a checklist. You don't have to analyze anything. It's not very hard, actually. And you can there are never any promises here, but theoretically, you can get a good return. Greenblatt says that he got more than 30% from 1988 to 2004. Now, 30%, that's a blast. And he owned 30 stocks at a time. The disadvantage of this method, and there are some for sure, that's why I'm not doing it, there will be times when you won't even match the market, where you won't even match the indices. And that's not the major disadvantage, though, because that happens with a lot of different types of value investing styles. The big disadvantage, I think, is if you really look at what you're investing in, it's like looking through the garbage can. It's a lot of crap also. There might be some wonderful companies that just happen to go through some kind of event that made them really cheap, but there will be a lot of companies that are really bad companies, and that's why they're cheap. You can get a high, 30%, that's pretty high, a high average return, but you'll never get the multi-baggers, the 20-baggers, the 100-baggers, the companies that will multiply your investment many times over. Why not? Well, because in this system, and we'll get into how it works more specifically, in this system, you're selling it again. You're not keeping it forever. And another disadvantage is that you get an average. You get an average of these 30 companies. You get an average return, even though I do admit 30%, that's really a blast. But as you're not really looking at the companies, you're not getting the best. You're getting an average. And it's like you're investing from a pH stick, like you're investing from a moment in time instead of looking at the history of these companies. The most important disadvantages, though, are 1, you're really investing in some crap sometimes. 2, you'll never get the multi-baggers because in the system you sell it again. How do you do this? The way that Joe Greenblatt does it, you invest in 30 companies and rotate these companies. Okay, so you can either, it's actually really, really easy. You can either use, he has a website where you can do it, and it's called magicformulainvesting.com, or you can use another screener. For example, Yahoo Finance. That's a stock screener. They don't have the numbers that he's looking for, but instead of earnings yield, you'll use price earnings. And instead of return on invested capital, you can use return on assets, which should be a minimum of 25. On Joe Greenblatt's site, you can get either 30 companies or 50 companies. Let's look at it step by step, how you do it. And I know maybe you're driving, maybe you're going for a walk with your dog or whatever. So how are we doing this step by step? Don't worry, if you're walking your dog or driving, you don't have to write all this down. There's a cheat sheet, as I told you before. So this is how you do it. First, you choose how are you going to select these companies? Which screener are you going to do? And which numbers are you going to look at? Then you buy 5 to 7 of the best ranking among around 30 to 50 companies. You only buy for around 20 to 30% of the money you plan to invest during the first year. And you do this every second or third month until you have invested all of the money. After around 9 to 10 months, you will have invested in 20 to 30 companies. And that's enough. You don't need more. You can do more. You can always adjust the system. And you sell every stock when you've had it for about a year. Now, in some countries, there are different tax brackets. You pay less in taxes if you own it a bit more than a year. So if that's the case in your country, then of course, keep it a bit more than a year. And then you reinvest that money in a different company. And you do that at least for 3 to 5 years. It's really important not to give up, because there will be times where it will underperform, but keep at it, because statistically it will perform better than the market. So commit to at least 3 to 5 years. Remember, you can use this in so many different ways. You can combine it with whatever you want, basically. You could look at a minimum requirement for historical growth, or it could be if you have some particular ethical requirements, maybe you don't want to invest in, oil companies or whatever. You can write these things down so you have a plan, so you don't have to make decisions every time. Write exactly what it is that will be part of your screener. There are certain things that you have to avoid, though, at least according to Joe Greenblatt. Avoid financial companies like banks. Avoid also ADR, American Depository Receipt. These are, for example, it could be Chinese companies that are on the American stock market. If you want to invest in Chinese company, it's better to invest through the Hong Kong Stock Exchange. And also avoid anything with a PE below 5. Greenblatt says it's too suspicious. I do agree with him with these 3 things. Avoid financial companies, avoid ADRs, and avoid anything with a PE below 5. This was the first alternative method. One thing that's really important is to remember it's never an either-or question. You can do both. A lot of us, we have different portfolios. Maybe we have a portfolio for, fund money, and maybe we have retirement portfolio. So you can choose one of them and say, for 3 to 5 years, I'm going to test this system and see how it works. Now I'm going to take you through another extreme. You could say that this more quantitative method is one end of a scalar. In the middle, you have the way that I invest. And the next one, I would call the set it and forget it method, the spawners method. This is very much inspired by Mohnish Pabrai, who is a really well-known value investor. He wrote this book, The Dando Investor, which does not talk about this method because he wrote this book before he committed to this method of investing. He was inspired by Nick Sleep, who William Green interviewed in this book, Richer, Wiser, Happier. The story of Nick Sleep is that they invested in very few companies, and they actually closed the fund and just told their investors, listen, just invest in the same 3-4 companies and just keep your money there. There's no reason that we have a fund. We're just buying stocks in this company and never trading them. You can do that yourself. So they closed the fund. He was so inspired, and Pabrai, Mohnish Pabrai, he was so inspired by their way of investing that he kind of developed it a little bit. So this way is something I picked up from interviews with Mohnish Pabrai on YouTube videos. If you go to his website, actually he has a YouTube channel as well. You can see some of the videos. But with his YouTube video, you kind of have to pick it here and there. I'll present it to you in a way where here you've got it. Okay, so the motto of it could be set it and forget it, as I said before. And he says that you should look at your portfolio like a museum of wonderful companies that you have collected over time. That's also the way that Warren Buffett invests. He very rarely sells any companies. He does sometimes, but a lot of the companies that he's invested in, he has kept for so many years. Pabrai's way of investing really developed a lot. And as he said in several interviews, during the lockdowns, the COVID lockdowns, he had a lot of time to read, and that's when he discovered Nick Sleep, and that's where he really changed his way of investing. Before, he was buying and selling and always hunting, and now he's buying and holding, which would give a better return. When I look at his investments, though, it seems like he's not doing the new way of investing 100% because it does take time to find these companies. So he's still doing, at least from what I can judge, I cannot read his mind, it looks like he's still doing the old way of investing, buying and selling. And why would that be? That's because you can't find these companies all the time. We'll get back to that. What are the benefits of doing it this way? Well, the benefit is that theoretically, you can get a really, really high return. If you find companies that can become 100 backers, that would be great, wouldn't it? Or 20 backers. And you don't need a lot of these kind of investments to become very rich. There are other advantages if you compare it with the buy and sell and buy and sell. With buy and sell, you're always hunting for something else. You're always on the lookout for something, for the next thing, for the next thing. With buy and hold, with extreme buy and hold, which I would call this, you can actually really relax once you've found your investment. But it really takes a lot of brain power, research, analysis to find them. They're very rare. And the disadvantage of buying and selling. Well, first of all, as I said, you're always hunting, which means it's a very active way of investing and very time consuming. And also, of course, you pay taxes every time you sell. So that's not super great. And if you're always selling, you'll never get the 20 or 100 backers because you're selling them again. Once they reach a certain valuation, well, you're out again. Once the stock price goes above the value inside the company, theoretically, you're out. So which kind of companies are we looking for? First of all, let's look at which kind of companies have a lot of growth. And I do have this. I will... This is everything that I say here I have from Mohnish Pabrai. This is not something I invented, just to give him credit. First of all, you have what he calls the mouse trap. And the mouse trap is a company that sells one very specific thing and nothing else. So they're really specialized. And the company that comes to mind, it could be something like Starbucks. They sell coffee. And that's it. It's coffee and a little bit of cakes, tea, of course, a few sandwiches. But it's super focused, really, if you think about it. It could also be, McDonald's, burgers, bit of coffee and so on. It could be Chipotle. There are many other companies. I know these three are the same industry. The second one is the allocator. The allocator is a company that's very good at allocating money. A perfect example of this is Berkshire Hathaway, Warren Buffett's company, of course. The third one is cannibals. Cannibals are companies, they kind of eat themselves, like cannibals eat people. This company eats itself because it's very good at buying back its own shares, at share buybacks. And what does that mean when you buy back your own shares? Well, if you look at the company like a pizza, big pizza, and if this pizza is divided into 10 pieces, each pizza slice will be bigger than if it's divided into 5 pieces. When they buy back the shares, your stock will become worth more because there's more value in that particular share. So that means the stock price will go up. A lot of companies buy back their own shares. And some investments turn out to be pretty good investments, even though the company itself isn't growing that much, but it's buying back so many shares that it will make the stock go up. So that's another way of looking for growth. Another one is deep value, and this is the traditional Mohnish Pabrai way of investing. It means that you're looking inside the companies for assets that have been overlooked. And once the market realizes that there's some kind of value inside the company that they ignored, the stock will go up as well. Now we reach the fifth one, and the fifth one is really the important one, the spawners. The spawners do a little bit of many things. They will be good at innovating, copying, and acquiring. And they're very good at renewing the business. And we really want to look for the spawners. The idea here is, if you think of a company, usually a company will have a lifetime. And it depends how long that lifetime is. But, they will be young, they will grow a lot, they will mature, and then there will be a slow decline. But if the company is super good at prolonging that decline, like they invent new products, they acquire other businesses, they will prolong the landing strip. And even better than that, it's not just that the way downhill would be longer. In theory, they would go up for a longer time. So the landing strip is not the best picture to use here. So how can they do that? How can they prolong the lifetime and the growth phase? First of all, they can go into related businesses. And a mousetrap can actually do that. So if you take Starbucks, they went from only having the coffee shops to selling the coffee capsules in all kinds of shops, in any supermarket. And also you have all these small shops and machines, for example, in gas stations where you can get Starbucks. They didn't have that before. They can also, the menu that they have inside the coffee shop, they can expand on that. Instead of just selling coffee, they can sell coffee cups or whatever, hats. I don't think they do that, but it's something they could do. But the cups, for sure, they do. And in that way, within the mousetrap, they can go into really related businesses. It's still coffee, it's still snacks and a little bit of coffee, whatever, cups. But they are expanding what they do. The second way of prolonging this growth phase is acquisitions, acquiring other businesses. And a lot of companies do this, of course. It's very important that they acquire the right kind of businesses, that it's a good match. They shouldn't just go out and acquire crazy stuff. It has to be really high quality what they buy, and it has to be strategic, and it has to make sense with the kind of business that they run. One example could be Facebook. When they bought Instagram, that made a lot of sense. And they're making Instagram grow under their own wings. So today, if you want to run ads, this is how they basically make their money. With a few clicks, you can run the ads both on Facebook and on Instagram. That kind of makes sense. Then you have the cloners. The cloners are companies that copy what other companies do. And of course, as with acquisition, it has to make sense. They have to copy something related to their own business. One example of this could be how Microsoft stole from Mac. The whole Windows thing apparently is stolen from the Mac system. It could also be, Facebook, they're so good actually at cloning. So whenever something happens, let's say TikTok with the dancing video and the small videos, they started doing the reels in Instagram that are really, really similar to TikTok. Or you had Snapchat with the small stories or the small posts that would disappear within 24 hours. Well, Facebook created, with Instagram, they created stories that disappear within 24 hours. There are a lot of ways to do this, but always it has to make sense. And it has to be from the competitors. They have to copy from the competitors that might threaten them. Then you have when they go into not related businesses. And I just said, when they acquire, when they copy, it has to make sense. It has to be part of their business or make sense and be related to the business that they're in. Sometimes it happens that a company will expand or acquire something that's not related. But somehow it has to make strategic sense anyway. One example of this could be when Amazon created the cloud business. And Google did the same thing, actually. But it makes sense. And Amazon makes a lot of money from the cloud business that they drive. And that makes it possible for them to be really price competitive on other parts with whatever they sell on Amazon. The super spawners, you have the spawners, they'll do some of these things, maybe one of these things. But the super spawners are the ones who do all of it. They copy, they clone, they expand, they innovate, they acquire. They do all of it, and they do it a lot. Well, how do you find these? And how do you know you have a super spawner? This is the hard part. You really have to look for it, and you have to analyze, you have to think. So, this is also the drawback of this way of investing. You can't just sit down and quickly find a super spawner. It takes time. Let's look at some companies that I believe are super spawners. Amazon. They went into related business when they went from books to clothes and music and becoming the internet of all things. Acquisitions, they purchased things like Audible and Whole Foods and a lot of other companies, just a lot of things. Cloning, with not a lot of success, they cloned a smartphone. They made the Fire phone and WebPay. And then the not so related businesses, which was Amazon Web Service, the cloud business, and also the Kindle. You could say it was related to selling books, but not at the time. They were selling books, and then they made a gadget. But it makes a lot of sense. Another one would be Google, also known as Alphabet. They went into related business when they went from being a search engine to having a web browser, Chrome. Acquisition, for example, they acquired YouTube. Cloning, there was also a Google phone, I believe, not so successful. And not related, again, they have Google Cloud. Alibaba, they went into related, what would be Alipay, acquisition, for example, Ali Health, cloning, Ali Wang Wang, and not related, again, they also have Alibaba Cloud. So these are just some examples, and I cannot give you a lot of examples. I have these examples, to be quite honest, from Mohnish Pabrai, because these companies are not that easy to find. You really have to think about it. The trick, so actually, you might be thinking right now, why not just invest in these? Well, you could. I mean, it's an option, but first of all, you have to think about the valuation. What is this company worth and what's the stock price at? And these might not be at the right stock price to invest in them right now. So you have to think about that. But there's another thing, and that is the best thing is to find them before they're too big, because there is a limit to how big companies get. Of course, nothing goes into the sky, right, as you say. So really great would be if you could find them with, if their market cap is less than 500 million. And the market cap is just the number of shares times the stock price. That's it. It's very easy. You can always look it up. Again, you can just Google most of these numbers I mentioned. You can just Google it, Google the company, and you'll find it. It's that easy. For example, with the PE or with the market cap. So how do you find them, these super spawners? You have to look at the history. How have they behaved? And this requires some research, honestly. Are they good at copying, acquiring the right things, testing things? One thing that's also super important is that they know how to shut things down. So if you look at the main company as the mothership, you can imagine that you've got this mothership and then they will send out testers in the water to see if it works, to see if it floats. And if it doesn't float, they have to be really good at shutting it down. Otherwise, they will create like little holes that would drain the company of profit. We don't want that either. So they have to have the focus on the mothership and then test things. How do you know if they're doing that? Well, look at how they behave. Have they historically tested something that wasn't successful? Did they shut it down? What do they do when things don't go the way that they planned? The disadvantage of this way of investing is that it does take a lot of time because you need to research them, you need to look for them. But once you find these companies that are super spawners, you can basically kick back and relax. I mean, with everything you invest in, you should always evaluate and look at the annual reports, listen in on the earnings calls. But other than that, you can just keep them. You don't have to hunt for another one if you have some good ones of these. How many can you expect to find of super spawners? I would say if you find one a year, you're really, really, really good. It's not easy to find. And that's why, like I said in the beginning, remember, it's not either or. You can use these frameworks at the same time. You can do both. You can do the quantitative method. You can follow a checklist and invest in companies where you invest, but knowing that you might sell it later. And at the same time, look for these super spawners. But also remember, you always have to keep an eye on the stock price. Where is it compared with what the company is actually worth, the value of the company? Because even the best company can turn out to be quite a horrible investment if you buy this stock when it's completely overvalued, when it's in bubble territory. You don't want to do that. You want to keep you're still a value investor, remember? So yeah, that's what I had for you today. It's a reminder that there are different ways of being a value investor. Just to round this up, I really do believe in setting and forgetting. I really do believe in taking the company through a checklist. I do believe in super spawners. I would love to have a portfolio only of super spawners, but we can't always find them when we want to. So that's why we want to use different instruments, being a value investor in several different ways sometimes. And also depending on where we are in our life, how much time we have, we can play with these different kind of instruments. Remember that it's not either or, it's both and you can adjust these different ways of investing to your own style. Thanks for listening. If you enjoyed this episode, don't forget to like, follow, and review it on your favorite platform. It really helps the podcast grow. If you have any questions, feel free to write me at X. My handle is my first name, Beile, spelled B-E-I-L-E.